May the 4th be with you as Darth Vader hikes rates to 5% yesterday. Here's what you need to know before the bell. Of course, yesterday, Jerome Powell, the Darth Vader of our story, hiked rates to 5% yesterday and noted that, well, we've now kind of reached that terminal rate here that we've been expecting. This is what the market's been hoping for, is for the Fed to pause. While the Fed did not actually say they were going to pause, they did allude to the fact that there is sufficiently restrictive policy in place now, and now that bank lending standards are becoming tighter, that will act as additional drag on economic growth. That's the risk potentially of that recession later in the year or next year, as even mentioned by Jerome Powell during his press conference yesterday. The markets were rallying into the announcement yesterday, but those comments during that press conference about restrictive policy, potential recession, etc., caused a little bit of angst here, and particularly Jerome Powell stated that there is no real condition here for the Fed to start cutting rates. That was a disappointment to the markets, which are already pricing in 180 basis points of rate cuts by the first half of next year. That led to a market sell-off yesterday. We took out the 20-day moving average. Again, still on that sell signal, so the sell-off, not surprising. These sell signals tend to pick this stuff up in advance. So again, we've been on a sell signal here. The market's been struggling here for the last couple of weeks. We are not really oversold here. And here's kind of the important point on this, is that what you're looking for your next buying opportunity as when the markets are, really kind of in that sell-off mode, the MACD is getting fairly deeply oversold. We're not anywhere close to that right now. And more importantly, the market on an overbought or oversold condition is pretty oversold, and we're not there yet either. So again, we're not quite to that point to where we really have a good setup to put equity allocations to work. So again, we continue to kind of use this market. We talked about this last week, using that rally to reduce risk, raise some cash, rebalance portfolios. That's turned out to be pretty good advice here so far. There's not a lot of downside risk, right around 4,000 potentially. There's a good bit of support between the 50-day and the 100-day moving average. The 200-day moving average sitting right below 4,000 at 39.50. So again, a good bit of support here for a pullback. Continue to watch for that as an opportunity to potentially have an opportunity here to put some money to work. But right now with the Fed now behind us, we have the employment report on Friday. Of course, the big news today, of course, PacWest, as well as Western Alliance on the ropes, another potential bank failure. That's going to be weighing on the banking stocks today as well. So expect some more market volatility today outside of that. But again, keep a watch on what markets are doing. We're still in a sell signal. Remain cautious for now. We'll get a better setup here in the near future to add equity risk to portfolios, but that time's not today. So may the 4th be with you, and we'll see you next time on Before the Bell.